Welcome everyone to today's RiskWire webcast. I'm Reena Agrawal, Research Economist at Veros, and with me is Eric Fox, Chief Economist at Veros. Remember the Fed's 50 basis point rate cut in September? It was supposed to revive the housing market. Mortgage rates had dipped to a promising 6.1% in anticipation, but then they took a U-turn and now are back up to 6.7%. Why is that happening?
Well, the Federal Reserve does not directly set mortgage rates. Instead, these rates are more closely tied to the 10-year Treasury yield. So the 10-year Treasury yield goes down, mortgage rates are then going to go down.
So what influences Treasury yields?
Well, looking back to July 2023 through September 2024, the Fed kept the federal funds rate constant. Yet during that time period, the 10-year Treasury yield dropped from 4.4% to 3.6%. So the market was anticipating a series of federal fund rate cuts in the future and priced that into the 10-year Treasury yields. When we were asked in September what would happen to mortgage rates with the expected Fed rate cut, we said the likely outcome would be that mortgage rates would remain flat because everything was already priced in. And that's exactly what happened.
So given what has happened with the Fed rate cuts thus far, why are mortgage rates going up?
Well, note that the 10-year Treasuries anticipate many federal fund rate cuts in the future, including the one that happened this past September, some between now and the end of the year, and even more in 2025. Anything that causes disruptions to those expectations will cause the 10-year yields to change, which will impact mortgage interest rates. And that's precisely what has happened since September. Recent economic data, such as continued economic growth, where our GDP was 2.8% in the third quarter, higher than expected inflation in September, and lower than expected unemployment rate of 4.1% in October, has led to increased investor expectations of persistent inflation. That's caused the 10-year Treasury yield to rise, which in turn has pushed mortgage rates higher. So, despite the Fed's rate cuts.
Thank you for that interesting discussion on yields and mortgage rates. Remember the start of 2024, many had predicted that mortgage rates would dip down to below 6%. Will we see this prediction materialize anytime soon?
I don't think so. As I just mentioned, the Fed cutting rates doesn't mean mortgage interest rates will go down. I think the era of 3% mortgage interest rates is a thing of the past, and I don't expect to see them again unless there's some kind of exogenous event like another pandemic. Getting them below 6% will mean inflation is very subdued and the economy is slowing, which we just don't see now. Will they never be 6% again? I really doubt that. But in the foreseeable future, I don't see sub 6% mortgage interest rates.
Thank you for that interesting discussion. Thanks for watching. I'm Reena Agrawal.
And I'm Eric Fox.
For more insights, visit riskwire.com and don't forget to subscribe.